Hi, this is Brian Dolan with the law firm Pepper Hamilton. Pepper has been a sponsor of iGlobal's Independent Sponsor Summit in New York City for the last couple of years. In this podcast, we're joined by Pepper attorneys Julie Corelli, Ben Mittman, and Jeremy Levy. Julie joined a panel at the summit this year, was also able to give a 10-minute talk to the conference while Ben and Jeremy were active attendees. Ben and Jeremy, let's start with you. I saw you both working the conference and talking to a lot of attendees. What were you hearing about the independent sponsor space from the capital providers and independent sponsors that were in attendance? Jeremy, let's throw it to you first.
Sure. Thanks for having me. I think people were talking, big picture about the relative boom in the number of deals involving independent sponsors in the past several years. There are more and more sponsors out there. There are more and more funds that are interested in working with them. More and more funds, frankly, that are focused specifically on working with independent sponsors. And as a result, the process involving independent sponsors is a bit more streamlined. There's more of an established market for the terms and dealing with them, and so everything just moves quicker, and independent sponsors are more prevalent. So the capital providers who I was speaking to were basically asking for introductions to as many independent sponsors as we knew, and the same was the case for the independent sponsors. They're more and more interested in identifying specific funds that focus on working with independent sponsors. So it seems like an exciting time to be an independent sponsor, to be a capital provider, and to counsel working with them.
Thanks, Jeremy. I had a similar experience. I had a really good opportunity to speak to both capital providers, the independent sponsors, a couple of representatives of family offices, and the same issues kept coming up. Capital providers were certainly expressing some frustration with being able to get access to deal flow. And then the independent sponsors were sort of trying to figure out what are the best techniques or strategies to get before the capital providers, and how do they bridge that gap between them. I've given some of my perspective on our own clients and how they manage that process. I've heard some expressed skepticism from some of the independent sponsors about how they can get their own investors to make referrals, and their inclination to make those referrals, given that they may want to sort of keep their hands on their own independent sponsor. But our experience is that, usually, and depending on the size of the family office, the investor, the high net worth individual, that most of our independent sponsors are getting those referrals internally and across the spectrum to different investors through their contacts. So it's a matter of just managing that process and getting before the right people.
Julie, would you care to share any of your perspectives from the folks you talked to?
I think the word that was mentioned the most, by the way, thank you for having me on the podcast. The word that I heard mentioned the most was probably relationships, and how to build those relationships was the topic of a lot of discussion. It seems very natural to people that deal flow and opportunity and the smoothness of working together comes from a deep relationship. But a lot of independent sponsors, I think, were expressing a little bit of frustration in how they get from here to there. That may be point B, but they're at point A, and how do they progress to where they have those kind of relationships with capital providers? Capital providers were similarly talking about what they expect of independent sponsors that help to build those relationships. So some nuggets of information that came out of it were clearly timing of deals, deal flow, as Ben and Jeremy both mentioned, was probably one of the most important things, but the ability to work together in a rapid fashion, given the timing exigencies of particular deals, was probably one of the fundamental pillars of relationships that people were looking for.
That's great. Thanks, everyone. Julie, in addition to being on the Generating Deal Flow panel, you were also able to give a well-received talk to the whole summit on structuring an independent sponsor program. I wanted to give our listeners that weren't there some insights that you could share with them from being in New York that day. Can you and Ben go over some of the key parts of your discussion?
The topic of the speech was how to best structure an independent sponsor program and its SPVs, special purpose vehicles, to ensure the economics that support the independent sponsor's firm, how to reassure target portfolio companies that you have the ability to close, and position the independent sponsor for growth. In other words, leveling the playing field when competing against co-investing private equity firms. It was a 10-minute address, and I tried to give the perspectives of our practice at Pepper, which is representing all kinds of investment vehicles, from committed funds to independent sponsors and to structuring family office programs and everything in between. Those investment vehicles that we work on are in all kinds of industries, so the speech was not geared towards any kind of specific sector. It was really industry agnostic, and looked at some of the tax attributes, some of the relationship attributes, as we were just mentioning, that are critical to structuring your firm and to running your deals. I'll let Ben take a little bit of the theme on the essentials for any kind of independent sponsored program, and then I'll pick up with some of the more details that we talked about.
Sure. You need to absolutely have the right team that you can work with, that you have synergies with. Perhaps, specific talents that are not available to yourself that you can find within your partner. The team has to be dedicated in talent, and your approach has to be consistent throughout. It's critical that you not be out of the market at any time. You need to be able to have an adequate deal flow, deal evaluation, deal structures, deal quality, deal tempo. These are all concepts that are critical to make sure that you and your team are aligned on. You have to know what your advantages and disadvantages are, and that's what positions you for growth. You have to advise your sellers. You have to be able to show them what you can bring to the table, what your value add is to any transaction. You have to know the rules of the game, and by that I mean the difference between what can and what should be done. Valuation, legal, accounting, these are all important components of how you set up your SPVs, how you set up your deal structure. You need to use good advisors who know the rules and the difference between what and can and should be done. And good advisors can also be an excellent source of referrals and a market test on what is out there. You need to be patient and be resilient, and you have to align yourself with investors who have those similar qualities. Getting into the technical aspects of the structure and how you set up your different investments and through your SPVs, why don't I kick that off to Julie?
One of the caveats that I gave the audience at the Independent Sponsor Conference was that there really is no magic bullet to structuring your firm, and that people may think that when lawyers get up and speak at a conference, there's going to be some great light shed on what they're doing right and what they're doing wrong. But I did caution the audience that they would probably have more questions coming out of the discussion than they would answers, especially in today's environment after tax reform, when people are still trying to figure out a lot of what's going on. So one of the things we focused on in the presentation was the choice of entity, whether the independent sponsor should itself be a corporation, which could be a C or an S corporation, or whether it should be a limited liability company. One of the things the tax reform did not resolve was the strange treatment the tax code gives to distributions as between an S corporation and an LLC when it comes to unemployment tax. Distributions out of an LLC are generally treated as compensation, whereas distributions out of an S corporation would actually be, so long as you pay reasonable salary in the S corporation, not subject to employment taxes. So those things that create strangeness in structures, some of them still exist pre- and post-tax reform. A typical managing member, we learned from our experience with the audience participants at the conference and in our own experience, the typical independent sponsor is set up as a firm, just like an asset manager is with a private equity group. But they then set up special purpose vehicles to do the independent deals, separate deals. We call those SPVs, and it's just one of the acronyms that we throw into speech all the time. So that just means the special purpose vehicle that is set up to hold a particular investment. And one of the major differences between independent sponsors and private equity firms is that they have separate SPVs for every deal. The advantage is deal by deal carry economics, but the disadvantage is you have to raise money every time that you're doing an investment, whereas the private equity fund has commitments that they draw on to fund an investment, and of course they usually at least have net cumulative carry calculations in the vehicle.
Julie, what do you do if one of your investors has peculiarities? So the SPV that you've already baked up and socialized with your investor base, but all of a sudden an investor has a peculiar tax issue or regulatory issue or other issue?
Virtually every investor has peculiarities, so I smile at that term. But you have to start with a basic SPV and then work from there to address the particular investor peculiarities, as you say. So you might be structuring an SPV with feeder vehicles on top of it that serve as blockers for foreign investors, for blockers for tax-exempt investors. You might be creating special purpose vehicle number 2 to operate in parallel with for particular attributes, and no structure will end up looking the same investment to investment. They'll always have some nuances, unless, of course, the investor base is exactly the same. So we asked a couple of questions of the audience or I posed a couple of questions to the audience, whether your firm, meaning the independent sponsor, should be a C corporation. Generally, our experience is that it's probably not the case that it's a C corporation. While a 21% tax rate from the new tax reform may look enticing, there's also, in flow-through entities, the 20% deduction on qualified trade or business income for partnerships, S corporations, and sole proprietorships. So investment management is not an accepted business, so it doesn't apply. So that exception, does apply. And as I mentioned, there are these some advantages in employment taxes that need to be addressed. So no firm is going to have a one-size-fits-all answer. The general rule of thumb is that your independent sponsor firm is not a profit center. Compensation for most of them generally zeroes out at the end of the year. And each one has to look at its own planning and its own economics to determine which entity is the appropriate one for it to have. Then we ask the question, should those SPVs be a C corporation? Again, we think most likely not, that there are high expectations of distributions, then probably not a C corporation is the right, because you still do have double taxation despite the 21% interest. If you use C corporations in the SPV, there are changes in the way carry can be done, but now with 3-year long-term capital gain rate on carried interest, you have to look at the nature of the investment, the nature of its distributions, and plan accordingly. And then lastly, we looked at whether the portfolio company should be a C corporation. And there thought potentially that would be a yes, but it depends on the nature of your investors and the nature of expectations of distributions coming out of that. So clearly, one of the messages that I was trying to get across with it, you have to know your investor base, and knowing it is a huge plus to proper structuring. If there are foreign investors, tax exempt, as we mentioned earlier per Ben's question, you really have to be careful on the structuring to make sure that you don't subject your foreigners to effectively connected income or branch profits tax. And if you have tax exempt, you don't inadvertently subject them to unrelated business taxable income. So one of the structuring aspects that we also focus on when we're looking at structuring an SPV and the type of compensation that an independent sponsor receives, notably the carried interest, is whether there should be a special purpose vehicle that is a special member of the SPV to which the carry is distributed. Ben, you've done a lot of those structures. What do you think of that concept?
Sure. Sometimes when we have new clients, they have a specific idea of how the upper tier structure of their investment structure should look like, and they typically use the same GP entity for both the governance purposes as well as receiving the carry from the investment vehicle. Our recommendation usually to our clients is that they think about strongly having bifurcating those roles, or having a new GP for the investment as well as a new entity. So if your partnership, your fund, your investment vehicle is set up as a partnership, you would have a special limited partner. If your investment vehicle is an LLC, it will be a special member, where that special member not necessarily may be making a capital contribution or investment, but will be there to receive the carried interest. And that's what we recommend to our clients, to separate the governance functions from the general partner or the managing member, from the special limited partner and the special member.
And the reason for that is to bring the economics away from potential governance liability, right?
Correct. There's always, the unfortunate chance of litigation, investments going sour, and you'd like to be able to insulate that revenue stream from any, unfortunate litigation.
No guarantee it works, but it's at least one more hurdle for plaintiffs to overcome.
Sure. And the downside, obviously, you have another entity to manage administration costs, Delaware franchise taxes, what have you, but we think the benefit outweighs the risk.
Okay, so enough tax. That's where I felt I had lived up to my caveat in the speech to leave people with enough questions. We talked a little bit about how we advise independent sponsors to position themselves for success in assuring the target company they have the ability to close. Ben mentioned adding value and having knowledge about how to grow the company. That's clearly a theme across all the independent sponsors we talked to at the conference, and also the capital providers that partner with them. They really are looking for the sponsors to add value to the portfolio company. And that's a lot of reason, we believe, why we see sector-specific independent sponsors. Some sponsors might focus on providing high-level strategic and operational expertise. Others might focus on network and industry sales and distribution expertise and things like that. Clearly, the independent sponsors have to demonstrate the ability to close. As Ben mentioned earlier, without that, you definitely are at a disadvantage. And a lot of the questions we get, well, what's that mean? Does it mean you have to have a track record of closing deals? And I would answer that clearly in the affirmative. Well, how many do you have to have? 5 or more would probably be a number that gives people confidence that you're actually going to close, which just makes those first 5 the big hurdle that independent sponsors have to overcome. Talking to potential investors about their interest in niche sectors would clearly get you the investor interest to potentially close those 5 initial deals. But if you're not in a niche market, you're doing general investments, you're really going to rely more on having the ability to advise the company on its growth plans going forward. Exits are also an important piece, particularly to institutions. High net worth individuals tend to be more risk tolerant or at least have more variety in their level of risk tolerance. And family offices generally, yes, they're looking for exits, especially professionalized ones, but they have a lot more tolerance for patient capital and can stay along the way. Another way to ensure that people are definitely able to close is to have backstop commitments. And what does that mean? It means that you have somebody waiting in the wings who will fill that gap in the amount of capital that you need. There's usually a cost to that, or it's a special relationship. But if you have that ability to always know that you can fill the gap, you just don't know what amount it's going to be, you certainly have an advantage that gets you closer to the same level of certainty to close that a private equity group brings to the table. We also talked a little bit about models that are emerging in the market that are different from private equity and different from independent sponsors. It being an independent sponsor conference, we didn't spend a whole lot of time on that, but there are certainly models out there that involve perpetual rolling fundraising to raise commitments, pseudo-committed funds, permanent equity, permanent capital type vehicles, things that offer private equity-like economics but a lower cost to the investor. And then lastly, we focused on the regulatory landscape. One of the issues that always independent sponsors are focused on are broker-dealer considerations because they do like to charge transaction fees. There's not much new there since the M&A broker exemption and the Ranieri and Blackstreet or no action letters. But we do have Jay Clayton as the SEC chair, who's moved away a bit from the broken windows enforcement mentality of Mary Jo White's SEC, so we're hopeful for that. And lastly, on the regulatory front, we talked about registration as investment advisors. Is it advisable? Is it inadvisable? And really, we focused on the fact that there isn't a choice. If you are counseling an SPV, as to the sale of a portfolio company, you really are rendering advice from the Investment Advisors Act standpoint. While the purchase transaction may be an investment decision made by the investor, it is still usually the independent sponsor's role to decide if the SPV is selling. So you have to look very, very carefully at the terms of the SPV, the role it has in the investment, and how that fits into whether the independent sponsored firm is providing advice for compensation to determine what are the regulatory requirements under the Investment Advisors Act. I did cover all of that in about 10 minutes in the speech, speaking very fast, but I hope this is all helpful to people, and if other people have questions, please feel free to contact any one of us.
Well, that was great. Thanks to all three of you for joining us today. I definitely think our listeners got a good feel for what you were going over, and I think you even went a little deeper today. As Julie mentioned, if you do have any questions about what you heard, feel free to reach out to any of our speakers. Their bios are linked off this podcast, which is off Pepper's Insight Center at www.pepperlaw.com.